gold price is not capped by someone feeling pain when they need to pass the purchase price of the raw material onto an end user, like it would be for copper or for steel or something like that. Gold ownership seems to be motivated by ownership and not by price. So I think that probably means that it's just uncapped.
Hedley Widdup, it's been like 6 months since we've had you sitting in this chair.
Wowzers.
A lot's changed in 6 months. I mean, we were delighted when you I think I had the thumbnail for your episode made before you actually sat in the chair, and it was gold stocks yet to run, which was great. Got a lot of eyeballs. And we did talk about a bunch of gold stocks, and a lot of them have run a long way since, but I put the words in your mouth a little bit. I'm not going to do it this time. I want you to tell me if gold stocks still have room to run.
Well, the reason that they've all run is not because they're great companies. Quite a few of them are, but it's the gold price which has unlocked it for them. So I suppose your question really is gold price going to lead them any higher? There are so many fundamentals around that which I think are interesting. But you can't talk about the fundamentals for gold around what's happened in the last 6 months or what will happen in the next 6 months, because I think you need to have a very long-term mindset with gold. And I think it's fascinating. We've seen headlines probably in the last 12 months where, particularly the media that often doesn't like or doesn't really give a shit too much about gold, but picks it up because it's a story. Why is it going up? Central banks are buying. Central banks have been buying since not long after the GFC. And I think the reason for that, the BRIC nation central banks coming into the market, has been because they've perceived a world where they're no longer completely comfortable with holding US dollars as a majority of their treasury currency, want to diversify from purchasing treasuries. And I suppose that makes sense in the context of the way that the world looks now, but they'd taken an early view on that. And the trick for them, I think, was seeing stimulus issued primarily out of the US and Europe, and maybe coming to the view that Western nations are no longer happy to tolerate austerity in their economies if something bad happens. So we want a bit of diversity and pushes them towards gold. Now, I don't think that central bank buying necessarily has been responsible for pushing the price up either aggressively. Was it every day that the price has gone up, and when it pushed through $3,000, pushed through $3,500, pushed through $4,000, when it leveled out or topped out at 4.3 or whatever it was it a central bank buyer who pushed the button to say, I want to buy that piece of gold at that price? Who knows? But I think when central banks are buyers, they underpin a market with tightness. So they're absorbing so much volume that anyone else who wants to buy it is going to have to move the price. And they'll often do it at a time when, perhaps other investors are going to come along. So, you think back to the last couple of gold bull markets that have existed. The first one, which was as gold came out of being a pegged currency, so arguably it was an artificial price, might have been far too low. I think that probably contributed to a huge bull market that was about an 18 times return from the bottom to the top. There was central bank buying at that time. It was quite a robust market for central banks to be buying in. And that was a world where there was conflict. The 70s was probably, maybe not peak Cold War conflict, but there was a lot of Cold War associated. And when you say that, it's kind of like, anti-communist, anti-communist bloc, anti-communist influence type movements. And that played through the Middle East, that played through Russia, that played through Asia. And you saw, I suppose, gold became unpegged in 1971. You might argue, I probably wouldn't, but I can sort of see the argument that the people who were taking about $3 a barrel of US dollars in exchange for their oil might have had a mentality shift where they said, well, we're not so sure about the value of that dollar anymore because it's not backed by gold. So let's start to change the dynamic. Now, they changed that dynamic very rapidly, and it led to inflation because the oil price went up so dramatically. It was a symptom of a time where there was so much conflict. You fast forward to the end of the Cold War, 1992, the US had its Goldilocks decade almost, where everything was perfect, nothing was going wrong. The budget was balanced. The world was a place where it was fairly harmonious. There was very little actual conflict. So that was, I suppose, if you just think of a hump of, or even a trough, the central banks have been buying gold, world of conflict. You come out of the Cold War, all of a sudden we don't need it anymore, sold the gold, and that was a period where the price was depressed. But that overprinted a time when the gold industry was hedging ferociously as well. So in an interest rate environment where they could hedge, get an attractive price, they were selling more gold than they were producing at times, and that overprinted the price as well. That had to end, and I think there's all sorts of turning points you can see, but Enron, which was a massive derivatives scam on a balance sheet in the US, made a lot of the financial market feel very differently about derivatives. So all of a sudden, things like gold forwards, which are derivatives, and some of them were simple, but some of them were awfully complex, suddenly came into focus, and it was like, we need to unwind this. So I think that second gold bull market, which started circa 2000, 99, 2000, it was probably two gold bull markets. One fed straight into the other, and there was nothing in between except for the GFC. So you had the gold industry as massive buying participants buying back their hedges, and that was no doubt pushing the price because that was extraordinarily aggressive buying. In the absence of central banks buying, central banks were selling and probably fed into some of that, but you tip the scales of a delicate supply-demand balance, and all of a sudden the price started to move, and that drove more and more and more de-hedging until eventually the industry was largely de-hedged. That was circa, 2006-07, I think, was sort of, peak de-hedging, or you'd eradicated most of the global hedge book by that time. And you find yourself in the post-global financial crisis world where, of course, stimulus had come about and all of a sudden central banks were buying again. So central banks suddenly coming back to the market, the BRICS, and probably, as a movement of non-organised buyers, or with a similar motivation, I suspect that probably hits a market like that fairly aggressively. So I think the first half of that bull market was driven by de-hedging. The second half of it was sort of driven by stimulus-induced central bank interest that all of a sudden came about. And that interest has been maintained since. But then, there's an ebb and flow of how much gold is supplying the at-market demand. And I don't think that there's actually much gold comes out of vaults that's sat there for 100 years and then someone goes, I want to sell it now. Most gold that gets transacted in 12 months, I think, is arguably out of the ground in that same 12 months. So there is a real kind of demand-supply interaction that takes place there. So if you overlay the gold price with annual gold production, where you see flat spots in gold production, or even where it tails off, like coming into the 70s, South African production was declining and it wasn't being replaced by anything. So gold supply was genuinely tightening just as the price was floated, as those central banks were absorbing a lot of it, and there was investor demand because suddenly US citizens could own it at that time as well. So we saw a similar instance at the end of that gold bull market, sort of circa 2011 and 12. Production was ticking up and it was starting to expand rapidly. And in fact, the 70s bull market of gold corresponds with the CIL transformation of the gold market. Gold production went up in a period of about 15 years, about 2.3 times, and that was because low-grade waste dumps, tailings dams suddenly became economic because of this trend towards processing with cyanide in leach or pulp, and that changed the economics of gold. So, that supply and demand overlaps that as well. So where we are now, are we moving into a world of conflict? I guess I just see it in simplistic sense. I think we're probably moving further into that rather than away from it. I don't know if you could say we're having Cold War II yet, but we might look back in 10 years' time and say, yep, we were definitely within that period then. The industry is not expanding supply. Year on year, I think about 5 years or so, a flat spot in global production right now. And, I think the industry is displaying a fair bit of discipline about that. But gold is not unlike other commodities in being constrained in what new sources can rapidly be brought into the market. And central banks are buying. But I don't think that's what's driving the price, as I started with. I think investor demand has contributed, probably driven by a few of those themes and a few other concepts, but they're the large ones that I see as the moving parts. So now I'm not going to say a number because this is the one thing in life that I'm very superstitious about, because if I say a number, and I did this like 4 weeks ago, I was talking to Grady Wolf before she went on maternity leave, and she said, all right, mate, I want a gold price for 12 months' time. And, she's got a bit of a forceful question asking, and so I thought, I'm just going to have to say a number. So I did, and then the next day the gold price started to fall. So I won't give you a number, but I think there is a lot of robustness. It's hard, I think, just with that setup to think that gold could fall back through 3.5. Is it going to fall meaningfully back through 4? I don't really think so. Where we saw the pullback, it had reached a spot of, in terms of a distance above its 200-day and 200-week moving average, where gold would often pull back in previous bull markets. So, to me, it looks like a natural part of the volatility. And if it's not going down, then I guess it's going up. as to how much, well, gold price is not capped by someone feeling pain when they need to pass the purchase price of the raw material onto an end user, like it would be for copper or for steel or something like that. Gold ownership seems to be motivated by ownership and not by price. So I think that probably means that it's just uncapped. But that could mean that we slowly creep, towards the next big increment, or it could mean that we push to it aggressively at some stage in the future when there's a coalition of short-term drivers as well. So sorry for the sermon. I think that devolved quite quickly. It's like, how are you, Trav? Now listen for 10 minutes.
That's fantastic macro overlay to how we got here, Hedley. I just want you to layer on one more detail, the US dollar, the other side of the coin there, and how we price things. What do you think's happening there in the foreseeable?
Yeah, well, your discussion about the US dollar can verge into conspiracies, and it can verge
not on this channel.
We're all quite logical and rational around here.
Our conspiracies are the real ones.
Well, I mean, there's no lack of sort of obvious drivers of de-dollarization, and I think deglobalization probably aids the demonetization or the lack of support of US dollars. I think probably the biggest part of that is just where, if you go back 15 or 20 years ago, there were nations which were building their wealth, particularly big ones like China and India coming on its coattails now. They were growing their wealth. They weren't really in a position to say, in a perfect world, how would we build our global foreign reserve bank? They probably had one choice, which was, we trade in US dollars, so we need to build reserves of that. And that's a safe place to be because it earns some interest, but it's also protected by the biggest economy in the world and the strength that comes with that. Fast forward to now, I think if they were to say, let's just wipe the slate clean and start again, the US dollar would play a very different role for them. And I suppose just those two as markers where you've gone from a position of confidence to a position of far less confidence, that probably maps a trajectory. Interest rates are going to play a role in that, and we're talking. We don't talk about inflation in Australia anymore. I think I saw a headline the other day that said that we're talking about gymflation, but we're going to see interest rates in Australia probably be belligerently stuck at a level, or maybe even bumping up a bit if inflation doesn't go away, and that's probably going to see money flow towards the Aussie dollar. But if we're going to be producing more and more commodities into potentially the expansion of a boom, particularly driven by things like electrification and just expanding known sources of supply to meet growing demand that comes from some of those new sources, then Australian dollar will tend to have a bit of a buffer, a driver to it as well. So I think there's two forces there which kind of in opposite directions but coalesce in the US dollar having some weakness to it. I don't mean the Aussie dollar forces the US down. It's more there's going to be a bunch of currencies who are producers of things that would naturally see some buoyancy in their currency probably in the next 10 years. And that's against the backdrop of US dollar probably just not having the allure that it used to.
Tell me about this boom, Hedley, because you've got a slide in Lions Elections AGM address, which was yesterday at the time we're recording, 2025, the year the mining boom began.
Yep. Mining booms don't start suddenly. They tend to be a bit of a whimper. Now, I think we've seen a very, very aggressive overlay on that, which is the gold price. And I would argue that gold price is what has started that boom. It's brought liquidity back to the mining space. But I should take a step back because we think and talk about mining cycles a lot at Lion. It's something which drives our investing behaviours. We try to align buying to weak markets and selling to strong markets. So we're very alert to what we think is going on. It doesn't mean that's what's going on, but we've found ourselves fairly close to the mark on a number of occasions. So that, and we express that as a clock. At the top of the clock, 12 o'clock is when the boom stops and the bust begins. And we've talked about that as in a Cinderella analogy in the past because, Cinderella was at the ball and at 12 midnight, the clock struck, her dress turned back into tatters and her coach into a pumpkin, etc. So, that's a nice story for the top of the boom. There's not so many stories for the bottom of the boom, but you go through the bust and you find yourself at 6 o'clock, which is where the boom starts. And there'll be a day where some indicator that you can look back on and you'll say, right, the boom started at that day. But that's only because that was the bottom in a trend, and it sort of levels out, and it might be slow or it might be quick that it goes up from there. So we've been watching liquidity trends for years and years and years now. One of the ones which we keep a close eye on is IPOs, particularly onto the Australian market. The Canadian market lists new companies in a completely different way, and it's not uncommon to list a company with no assets there to be ready for an asset. So, the SPAC type thing, but just on a much smaller scale. In Australia, you can't do that. You can only list a company when you have some assets, which means that the IPO market is judging those assets on the face of them based on a prospectus, which I don't want to be flippant, but I don't think too many people get much of a view on an asset from a prospectus because they will hear the story in a presentation and they're not able to assess, a year's worth or 2 years' worth of news flow to see what sort of gradient the company's been on. So you have to make a judgment at a price to contribute to an amount of money being raised, and that's a hurdle requirement for the company to list. So in a shit market, in a bust market, you just can't list companies, and you tend to get a declining trend of number of IPOs. You can overlay the amount of money that's been raised for sure, but that's a lot harder work than just counting the number of IPOs, and that curve tends to be the same shape for the capital raised versus the numbers. So in I can't remember if it was 2020 or 21 was the peak year for IPOs. I suspect it was 21. We've seen a decline year on year since. 2024, we had a number of IPOs. I don't know the number. Let's say it was 13. Up until the end of October 2025, we'd had, I think it was 15, so 2 more year to date. But the first quarter of 2025 saw 0 actual IPOs. There was a couple of new listings. One of them was the combination of Southern Cross Gold with its Canadian company listed here. Didn't raise any money. It was a compliance listing of 2 existing companies that have come together. The other was a listing of a Canadian copper company, which also didn't raise any money. And I think it actually took it till August to trade. So those new listings weren't emblematic of anything.
Very marker.
Yeah. We've had 15 genuine IPOs in 2025, and they have all happened since, I think, the end of June. So, it's really only a story. In fact, it might have been the start of June. It's really only a story of a bit of Q2, mostly Q3, and here we are in Q4, marking that trend. So it's kind of like half a year's worth of activity, which has already surpassed what happened in 2024. So liquidity has gone up on that measure. Does that drag you out of a boom, out of a bust? So I suppose that's the next question. And that's hard to say, but this is the reason why we think that booms start gradually, and what we've seen is probably an aggressive start, but is unlikely to be a template for what we should expect for full month November, December, and first half of 2026. I think really what we should expect for 2026 is that we're just seeing companies come more slowly to market. There's probably going to be a robust raising trend, which is going to zigzag, but will go up over time, and that's going to be across the commodity spectrum. But for now, it's been driven by gold. What I can say with great confidence is that gold price rise has got investors thinking about investing in copper companies and other companies of different commodities. Let's forget something like rare earths for now, because that's got a driver of its own, and I think that's contributed to its own little liquidity bust. But so something like copper has been butting up against a maximum price for like the last 5 years. It hasn't really had a bust in copper. So why was it harder to invest in a copper company 12 months ago than it might be now? Copper companies raising money. It's not the price that's done that. So, but I think the gold price has got people looking at companies at an earlier stage, and that's rubbing off of a bit of an investment appetite. But then the final thing I'd say is that global mining indices, many commodity prices, had a peak in 2021, 22. If you were Rio or BHP, it was actually more like 2023, early 23. But company and BHP and Rio, I think, fell something like 25-ish, 30-ish% from their peak to whatever the bottom was for them. Things like TECK, Glencore, Anglo, they were more like 50%. So what we see in Australia, just by our indices, haven't been as aggressive as maybe it was for some of those other global majors. Micro caps, massively fell. They were down almost 80% just on a median measure. April 2025, which was Trump's tariff
Liberation Day,
Liberation Week, tariff panic, TECK.TO, all those things, coinciding in early April, and that was the bottom from many commodities. So not many of those have bounced up, but many of them have sort of gone from a downwards drift to a zigzag, which is kind of like breaking out of a downwards trend. Gold has done its own thing over that period of time, but even microcaps on a median that I measure of about 600 companies have bottomed out in April and have moved up meaningfully since. And that has been driven by gold, but it's included many, many things which aren't gold as well. So this liquidity is now playing out in some price. BHP and Rio, I think, have driven the Australian ASX 100 Resources Index to outperform the ASX industrials of the same 100 stocks, which is the other half of the market, for a period of about 3 or 4 months, which is the first time that's happened since, I think, 2022. So, there's a lot of things there which I suppose line up to me to say we're going through a turning point. So the way that we've expressed it is we're moving through 6 now, the bottom of the market. And part of the careful choice of words is there's a number of people who enjoy telling me if I say at 6 o'clock that I'm picking a bottom, and there's a primary school giggle that comes on when you start picking bottoms, right? It's not, you get smelly fingers. In markets, it means something completely different. Yet, I'm just trying to avoid people saying, "Oh, well, are you saying
I've
this
never
now?"
thought of that. Now I can't get it out of my head.
Good. So, but we're also sort of sitting there going, well, if we're saying that it's past 6, we're past 6. Is it 7? Is it 6:30? Is it 1 past 6? And I don't know the answer to that. So the way that we've done it is we've sort of got some shaded arrows which start at 5:30, and the hard shaded arrow is at 6:30, and it's kind of indicating that we're going through that period. So I can't tell you how much money was raised in Australian gold developers in between, say, April-ish and let's say September, October-ish. It would have been a hell of a lot of money.
It's in the billions.
Yeah.
So I saw in the last quarter, ASX resource plays in general raised $3.5 billion in Q3 of the calendar year.
And there would have been a huge component of that which was gold driven, right? So, so is that something that we would expect to rub off across the rest of the market in 2026? I think we should probably cool our jets on that. But would we expect those measures, commodity prices, mining equities, etc., to be falling? My answer to that would be no. So I think we've pulled out of the bust, and the boom should just incrementally be upon us. And what we're trying to extract a trend from is what was been severely influenced by gold. So, but like I said, I'm confident enough that that's rubbed off on other things. What would really influence that would be, you can see the media speculating about a tech, extraction. Things like that tech phenomenon in the US don't tend to end with a slow extraction, or even with that market trading sideways for the next 10 years where everybody else's PEs catch up. I think it's more that money will tend to leak out of a number of those stories. And you see things like Drone Shield in Australia, and you can see how tightly perched some of those stocks are in terms of their fundamentals. But you need to have belief in the central character. And if they don't have belief, then the money comes flying out. That money will all go somewhere. And, my bet would be that there's quite a bit of that money that then goes, well, there's a lot of highly priced things in the tech market, so what are we going to do with it? But that money is earmarked for something specky. Why don't we have a look at gold?
Travis, you know what else happens when things heat up in the mining cycle?
So we're talking that clock goes from 6 to 7 to 8, is that what you mean?
Yeah, exactly. Mining services companies get busier and busier, and that means getting your orders in and getting your orders filled in short order gets a little bit more difficult. Now, Sandvik is not a company you really have to worry about this with because they look after their customers.
Look after them, yeah.
But
in general, mate.
In every facet of mining. But if I am thinking about putting that ground support order in, I'd probably want to do it sooner rather than later, wouldn't I?
You can give yourself a Christmas present by putting in a ground support order before Christmas.
Yeah, and you get the extra Christmas present of getting to speak with Derek Hurd, don't you?
Derek Hurd, he will make my Christmas. I know that. That is 100% certain.
It's going to make all of our Christmases, mate. So if you want to get the best ground support in the business, you should get on the phone or get in the show notes or use the app like Trav loves to do and put your order in for Sandvik ground support.
It's reliable when everyone else can't deliver on time because the industry's booming. Guess who you can trust? Sandvik ground support to deliver you all your ground support needs.
Go Sandvik.
Because a lot of these like large cap tech stocks, constitute an enormous amount of these US indexes, and like as that rotates maybe into commodities, would it not just like rotate into the very large name stuff first? Like shouldn't we be seeing like the likes of Rio and BHP leading the way in terms of early performance of a commodity bull market?
Well, they have performed.
They have.
I can't tell you what percentage it is, but they're up since April.
They are, yeah. And Rio looks particularly like it's about to break out, but yeah.
And I mean, well, let's just compare Rio and BHP, say now, and let's just mark it April 2025 and theorise that we're correct. If that was the bottom for Rio and BHP, what condition are they in now in terms of earnings, balance sheet, dividend payments, things like that? I think the market has a fairly balanced view towards them. You don't see much rhetoric in the market about how irresponsible they are or anything like that, or even coming off a base of, having disappointed people. I mean, they've done some things in a governance sense, or Rio, but that's still in the past, fairly distally now. It was 2019, I think, the Gorges incident. So, whereas if you compare that to 2016, which was the last time they pulled out of a bust, and we'd had that long, and it was a very severe bust coming off the back of the China boom. So 2011 through the 2015. Through that period, and particularly through 2015, what the headlines were saying about Rio and BHP was completely focused on their progressive dividends. And what they'd promised to do was to pay a bigger and bigger and bigger cents per share dividend every year. And they found themselves in 2015 having to fund that by taking on debt, which, the maths of that doesn't add up. It doesn't meet the pub test. I don't think anyone's had too many beers with the CEOs of those companies in pubs, so to speak. I think they probably have private dinners and it's all very civilised. But, they were getting pilloried for that. And when they walked away from it, so BHP and Rio both walked away from their progressive dividend policies within about a week and a half of each other. And that was within days of the bottom of the market. And you could see the media headlines. I don't know if it affected buying, but it certainly corresponded with a final down leg in their price, and then it was back up from there. So, it was a sentimental reversal there. And it was them coming off sort of being oversold, probably quite cheap at that stage. And at that point in the market, if the money was saying, oh, they're no longer irresponsible, so what are they? Oh, they're cheap. And so I think there was probably a fairly big weighting adjustment in the market which took place there, where money which had deserted BHP and Rio had probably always held it, just sort of edged back in a bit. Are we seeing that now? Well, there's no driver. There's certainly nothing to say there's been a change of mentality towards the likes of BHP and Rio. It's not like the market's saying, oh, they were idiots last year, but we've decided they're definitely not idiots now. Let's reassess them with just a completely objective financial mindset. So without that driver, I wouldn't expect there to be such an obvious change. But, passive money, I think, particularly if it's washing out of big cap tech, and even just trimming gains there, where's that going to wash into? If it's going to wash into commodities, that is the place which it's going to go, because those companies are streamlined for lazy money.
How do you think about the interplay of big deals as well? Obviously, we've got the Teck Anglo deal playing out. I know this plays a role in how you think about the mining cycle, but where are we with regards to big deals?
Yeah, that's a merger of two companies coming together for common good. Neither paying a premium for the other, neither having to give too much away, trying to genuinely blend themselves. And we've seen that activity at sort of somewhere between 3 and 4 o'clock, or 3 and 5 o'clock in the market in the past. We've also seen in the past majors opportunistically taking advantage of a huge pricing difference between themselves and juniors. And I think you could argue that there was a number of symptomatic deals like that. I mean, Capricorn for Warrada might be one. In the recent past, the disappearance of New World as well, where cash is being paid for something where the buyers are, not a natural owner, but they're doing so with the confidence that they can buy it for cash. They've been able to raise that, which has got an interest in commodities, and they think that they can push that into the future and then sell it at a much higher price. Wouldn't be a private equity deal if they didn't have that mentality. So I think much of that deal activity lines up. The one caveat you probably need to have when you talk about deals in the mining space, I think at the moment, is that there is still a very, very, very strong hangover from the pre-2011 conditions. And from 2000 and I'm going to say 5, 6-ish through to 2011, we were seeing some monstrous deals in the mining market. I mean, you had Rio for, I always get this wrong, it was Alcan, wasn't it? Which was just like peak hubris valuation. My goodness, what an irresponsible thing to do. And they paid for it. But there was a number of other investments which had been made by so many other companies, big companies. Bigs taking over smaller companies, big companies developing assets, and the amount of capex which was being paid. And I think, what big fund managers then, the BlackRocks of this world, were saying was, you've had such poor return on invested capital on these deals, and they became a bit activist about that. So there were many, many management teams which had turned over. And I think that introduced a mindset to mining deal making, which is maintained to this day. And it's a very, very good discipline. And we need a good old-fashioned, heart-throbbing boom to overcome it and have some silly deals. But I
just need the first mover to outperform massively, and then everyone copies them.
Yeah, I think that's the thing, right? So we haven't had a market which would support silly deal making. It's had to be quite well thought out across the board. There's things which have snuck in which might, particularly in retrospect, might not look so clever, but there's been, I think the decision making and the way that people are addressing the market and their shareholders and presenting deals has had to have that in mind, because leading up to, say, 2007 began to happen after that. You could make a deal and just say, as a gold example, if we go from having X ounces to 2X ounces, we'll be worth 2.1 times the market cap or 2.2 times the market cap. So it's a good deal. That's good for you shareholders. You shouldn't worry about a thing. Not worried about earnings. People were losing their jobs for that in the aftermath of it. And that's what these CEOs who are designing these deals, or maybe the CEOs who are signing off on these deals, are not wanting, is to lose their jobs over it.
Yeah, I've got a specific question that comes on the back of that, because I was listening to a conversation with a fund manager a couple of weeks ago, and he was making the case that it wasn't necessarily the fault of all these CEOs. They were being pressured by investors, particularly generalist investors who later flocked the sector, and for the 10 years after the fact, blamed the sector for poor capital allocation. And this brings another sort of thought to mind, which we were exchanging emails over earlier in the week, about how investors are now pressuring these companies to not do deals, as well as just trim down the portfolio and become very simplified, passive, investable companies. So would love to just hear your thoughts in general on how the investors dictate what these big companies do.
Yeah. Wow. Let's block out the rest of the day. There's so much in that. But let's address, say, investor pressure or investor expectations that lead to deal making. You do see it. It is definitely present, where there is a company that maybe has done quite well, built a project, for example, and then find themselves as a newly incumbent producer of something in a space, and they're probably addressing a whole new range of shareholders who they don't know very well. They certainly haven't known them for long. They don't know whether these people are there for a short time or a long time, or just a good time. And they definitely feel the pressure of, we as your new shareholders have a very firm expectation for how you will run our business. Aside of the fact that you've been running that business quite successfully for 10 years and that's how you've got to this point, we're now going to, give you a set of expectations. And I think that sometimes plays on minds of managing directors and CEOs. But at the end of the day, they've had a recipe that's got them to that point. So, there is this interplay then of how do I respond to market pressures? And some of those market pressures, I'm sure, are you've made your way into X index or X ETF, but to stay there, you really need to be bigger. So, have you thought about growth? Or you've built that project. What's next? Where does the growth come from? And I think, in a lot of cases, and over, I don't know, maybe over the last 15 years, I would say the market has probably become less willing to speculate on what a commodity price might do and pay that into a premium for the company. Now, for premium to sneak in, it probably has to have more to do with growth or excellence and delivery of excellence in what your earnings are going to be, which is one of the things which sets industrial companies aside from miners, because you can't value a miner on a PE and compare that to its peers and say, well, that one's very, very cheap. So it should naturally re-rate to that. If there's two people that are both selling ice creams, their PEs should be the same. And if one is out of kilter, then the other one will probably move to adjust to suit. So you can take a 20 or 30 year view on a model. It's probably not going to vary too much. The price of ice creams isn't going to spike in 1 year. If you're producing gold or iron ore or anything like that, that commodity price is what says you need to take a view on the commodity, trail it off, allow for inflation in costs, and have a net present value and a DCF, which is how you sort of value those companies. So, and I think that's where some of that pressure comes in, is from that growth aspect of needing to put something in that model. Because actually, I think Jake Klein said this on one of your interviews, and one of the quotes which resonated most with me, and I think I already knew it, I just hadn't put it into words, so I'm going to steal Jake's words, which is the biggest sensitivity you have in any project valuation isn't the OPEX, isn't the CAPEX, it isn't even the commodity price. It's how much metal you can put in there. So if you can see something that's got 5 years worth of metal production, but you, with your team of geos and people who've assessed it, can say, oh, no, this is much more likely to be 10 years. That's going to be a much, much more valuable project. Adding that 5 years on the end is going to have a far bigger outcome than flexing the commodity price or this whole business of, we're a better operator. We can skim 5% out of those costs, because you're assessing costs that you don't actually understand anyway until you're paying them. So then you extrapolate this discussion into passive money, and so we're really waving our arms now. But I wonder how that will play in, because there's several forms of institutional investor which probably influence companies who are susceptible to, will you grow? I want you to go and do a deal, and that'll satisfy me. I think passive money, particularly if it's in ETFs, is probably never going to be having that conversation. Hedge funds definitely will, and they can be quite aggressive in the way they pitch that. But I would say, I wouldn't say sophisticated, but they don't know as much about the assets that they're talking about putting together anywhere near as much as the people who are running the companies that they're talking about combining. So it's interesting, because they are obviously quite influential in getting into some people's heads. And I suppose a managing director that's built their company to the point where it's just entered an index, just started to attract ETF attention, and then suddenly their thought is, how do I stay here? They probably wouldn't have thought about that. And does their portfolio support that? Do they have the conviction to be able to say, we're going to be able to keep growing, expand our earnings? Or do we need to do something that involves bringing something in? And that's where you've seen, particularly in that sub-$1 billion market cap, or in the space that I look, the sub-$100 million market cap, those targets are very susceptible to that knee-jerk reaction of, we need that project, so we'll have to pay you for it. And when you're paying for a project that needs to be developed, there's a hell of a lot of risk that comes with, I think, the financials there. So, but then, passive money is an interesting one, because I think that builds up from time to time. I think there was an event which was referred to as the Nifty 50, which was back in the 70s.
Yep.
I don't know an awful lot about it. My basic understanding, though, is that there was money which was just, preferentially investing in big companies, safe companies, industrial companies, and applying, because the money was flooding in, it was applying high PEs. And that couldn't last forever. But it was a series of economic circumstances which coincided for people to want to have their money in those places. Didn't want it in banks particularly, didn't want it in bonds, very happy for it to be in equities. And there's been events like this, I suspect, over centuries, which have dragged people who might have been quite happy with interest-bearing investments, but have been convinced to buy, much like someone might sell you a set of Encyclopedia Britannica, you need to be in the stock market. Everybody on the street owns these. You got to buy some too. And I think the Nifty 50 was an episode where you had a lot of the middle class that weren't ordinarily stock buyers who became it. Once you start, you probably stick with it. And being in safe stocks and pricing them high, it's a recipe for something unwinding. We probably see shades of the same now. And there's been an awful lot of money, particularly through periods of stimulus, through periods where interest rates were low, people who have got their money in super and then see the ability to invest in things like ETFs as being an equally hands-off decision, but having something that has the capacity to provide a return which is superior to interest rates. So you become an equity investor, but you're not making any decisions really. That build-up of money and build-up of money in the super system has pushed money into places which, it doesn't have to make decisions, and it's just parking itself in bigger stocks, and that naturally prices them quite high. But then I think, that brings about, I suppose, if you've got a very, very active market where all of the big companies are subject to scrutiny from quite active markets managers, you've got a governance situation where you'll have probably sensible decisions made on governance that are based on ethics of two people having a conversation and coming to a landing. Or, it's broader than that, but in a simplified sense. When you have a lot of passive money, you end up with all sorts of, ESG type considerations that come into it, and exchanges that come up with rules like, you've got to have a majority of independent directors who don't own a single share in a company, which, when you, at the end of the day, if there's a director goes into a pub for the pub test and they don't own a share, there's a lot of people who are shareholders who are going to shout them down when you start to get into a bit of a boisterous discussion about what the future of the company should be. So I think when passive money is involved, it wants things which are simplified and siloed. So, can you invest in an ETF which is going to give you the best of all of the critical materials so you can just make one decision? I haven't looked, but I don't think it exists, because it would be a very, very difficult thing to construct and manage, and it would change daily. So for simple money or for passive money, a gold ETF is fantastic. You make the decision you want to be in gold equities. You go, all right, well, now I can decide, is it big or small? You've done the stake decision, all right? So I want a stake. It's got to be rare. I want pepper sauce. There's an ETF for that. And I think, you see this happening in some of the major companies as well. BHP, Rio, they're probably shades that we're very familiar with in Australia, and there would be different shades that are present in some of the other global majors that are not quite the same, but have a similar flavour to them. So over decades now, those companies have accumulated assets and divested. And you think about it, they're so big, they only want to be in very, very large commodity markets for most of their earnings. Rio has an industrial minerals business, which I think is interesting. Lots of small markets there, but doesn't contribute a whole lot to their earnings. So, what are they? They're iron ore businesses first and foremost. And they're now talking about bringing more and more copper into their business, which makes sense, because if copper's, going to break out of a 20-year trend like that fellow that you had on the show, embarrassingly, I can't remember his name, but it was a fascinating conversation about commodity cycles. Copper's been butting up against the price for 20 years. When's it going to burst out of that? If these guys are positioning for that, then they want more copper. They're not going to go and develop it. They're going to go and buy it in most cases. And that's going to make them into more streamlined copper companies. But they're fairly narrow in terms of, if you think about commodity diversity, if you want to be exposed to 10 different things in order to spread your earnings volatility out, they're never going to have that. And I think it's also interesting that, having really weighted themselves into iron ore, they made an absolute mozza off of that iron ore boom, which was driven by China. You guys have made the point before on this show of the easiest investment decision for any CEO of a company that's mining iron ore has been just to mine more iron ore. I don't want to single out individuals, but there's two big companies and there hasn't been many CEOs of them. And I think that has been a behaviour which they've fallen back on. It's going to be more difficult for them now, but just invest more in the Pilbara, and the return on capital is going to be brilliant. I was at a Melbourne Mining Club lunch, I think it was mid last year or mid this year. I can't remember exactly when, but there was a Rio presenter, and I was sitting on a table of students. There was one young lady who was absolutely busting to ask a question, and they didn't get to her. And she was quite disappointed that she didn't get her chance, but there was a lot of questions, so, too bad. So I said to her afterwards, I said, what was your question going to be? And she said, oh, well, I didn't quite know the right way to ask it, and I hope I would have figured that out first. But she goes, I was going to say, one of your predecessors, probably 50 or maybe 60 years ago, had to make a really, really brave decision to invest in building a big iron ore business in the Pilbara. And I'd argue that you've lived off of that ever since. It wasn't nearly as hard for you to make an investment decision as it was for them. Brilliant. That wasn't a question. That's just a statement that preceded. So what's the next brave decision that you might have to make? And is it going to be, I think it was going to be about lithium. So I was like, what a fantastic question.
It's brilliant. I mean, we talk about Rio's bad M&A all the time, but the best mining deal of all time was Rio Tinto buying North Limited.
Yep.
Just a tremendous, tremendous deal that paid dividends many, many, many times over, papered over horrible cracks that would emerge from bad decisions
Yeah.
later on.
Yeah.
The kind of pathway of the majors, it's an interesting thought experiment. I think my observations are that they are still influenced by activists, and activists take all different forms and shapes and sizes, but the large institutions who own them do have a lot of say in their portfolio composition decisions, and those portfolio composition decisions have been to become more streamlined, to be more reflective of an individual commodity, because that's where you get, like, some of the parts is greater than the whole, and it's kind of hard to argue with that when you see the very elevated multiples that copper, even like lithium companies, rare earth companies nowadays just trade at. Some of them are bonkers multiples, but even just if you just look at iron ore and copper, like there's a very different multiple applied there, and it's because of our expectations of what those price curves look like into the future. The irony of it is, we always project the iron ore curve to taper off and downwards over time. We always project the copper curve to taper upwards over time, and the inverse has kind of been true.
Yeah. Well, and it's funny too, isn't it? Because there was a point in time. In fact, I posted a calendar to my grandma at one stage. I think it cost me like $30. It would have been cheaper for BHP to send a ton of iron ore to China. The economies in those businesses are staggering. And if at that point you were selling iron ore for almost $200 and it cost you 30, that I can't see that margin ever existing in copper. Where can you get the efficiency on copper deposits which will give you that kind of a return? Unless you find something which is so enormous and it's 5%. It would be a geological freak. We're pricing companies now, probably applying a premium for passive money for simplicity and streamlining, probably applying a bit of a premium for moving into a world where, they're more exposed to things which aren't fossil fuels. So, there was a point there where whether it was the passive money or the activist money has said, we've bought into you because we want you to be an iron ore and copper company. And the CEO might rightfully have said, well, we're actually a coal company as well. Yeah, well, that's not good enough for us. We need you to get rid of it. That's an interesting discussion. And, it's driven by the carbon emissions and things like that. So I get all that part of it. It's just, whatever your business is, if you get someone who buys into it and then says, now I want you to sell something, it's kind of like, why didn't you just not bother? Why don't you just leave me to do it? Because it's profitable, it's rewarding shareholders, and now you're going to introduce all this risk to the business. So it introduces a really interesting dynamic.
Absolutely. Hedley, while we've still got you, we should talk about some of your portfolio companies as well. It's been a stellar year of returns for the portfolio companies in the Lion Selection Group's sort of holdings. I look at them. You've had some exits. You've had some entries. It seems like you're getting a little bit more commodity diversification in there as you've realised some exits. Mm-hmm. There's been some massive outperformers and some underperformers too. When I say underperformers, I mean we'll start there because it's like Brightstar. It's been flat in a gold bull market. What's going on there?
Well, we're still up nicely on Brightstar.
You had the auto realisation as well.
Yeah. So I think, I admire the strategy that Alex is going after there. And if you'd said to him 2 years ago, there's going to be all this stuff that you don't realise as you go about this, he probably would have gone, yeah, look, I know, but until it comes along, I can't really deal with it. One thing that I think he's done fantastically is pull together that sandstone greenstone belt within the Brightstar banner. It's the first time it's existed under that ownership for, well, it would be decades. Even
since Troy Resources?
Well, even I don't think Troy had the whole belt. I'd have to. They were mining there, but there have been, for a long periods of time, there's been bits and pieces everywhere. And I think, even prior to that, there was just a funny mixture of joint ventures and things like that. So this is 100%. It's all under their banner, and it's been an extraordinarily productive belt too, with not very much deep mining and not very much deep drilling. So if all you do is you say, and I think this number is about the number, but I can't recall. So, caveat, do your own research, all that. There's been about 4 million ounces come out of that belt production-wise. Now, what we know about other greenstone belts, which have had the likes of Northern Star or Evolution deploy exploration on them over 20 years is that you get a lot more ounces where you've already had productive mining close to the surface. So with 4 million ounces-ish having come out, what do I think of the Sandstone belt as? I think of it as a 5 to 10 million ounce position that hasn't been drilled yet. They already have a very considerable resource there. They're working towards a project study. The other part of the Bright Star business then is the smaller scale stuff that they're doing. And I think there's a lot of people who are trying to commercialize small gold assets. And what looked like a fairly easy set of low-hanging fruit to Bright Star initially has probably had a lot of other people try to creep into the space or scream into the space, which has no doubt made it harder, and it's been more competitive for selling ore. At the same time, they were quite advanced. They had a number of things which were ready to mine, and they've brought new production on. They're now, quite close, I think, to the point of being able to say they know how they can finance and know what they will build to have their own process facility. So that's advanced nicely, and I'm very, very comfortable with all of the progress they've made. The challenges that they've had, I would say, the first one is, and probably where their biggest down was, off the back of the June quarter, where they'd announced the June quarterly. They also had the Oramin deal in the market, and when they did the Oramin deal, they needed to raise money in order to support the much bigger ground position. And because you're under a scheme and you're operating and you're bringing things online, I don't think they were close to the wire. But if you were thinking as a CFO and going, well, here's what my projected cash position is going to be, but here's what the volatility could be, we do need to raise some money. There's no point raising a small amount of money. So I'm not speculating that they were close to the wire. It's more, under a scheme, you're not going to be able to raise money for months. So if you're going to raise it, it needs to be at that point. And if your intention is to ramp up your activity because you now own the whole belt, then that's why the money needs to come in. But when you raise money, and the amount they took, I think, was about $50 million. They have had new interest coming in all the time, but having piled that up on the screen, and then you raise money, you have all of that disappear into the book. So there's nowhere near as much buying on the screen, just as much selling. And because there's been some selling, people attribute that to a quarterly or to a deal or to whatever else. I think, there was a bit of a softening for them around a number of things there, and there just wasn't much to pick it up. So, to Alex's credit, he was buying stock at the bottom, and I think that was probably one of the things which, and it wasn't like he was investing 20 grand. It was meaningful amounts of money that he was investing, and it wasn't once. I think there was 3 change of interest notices that came out for him. They then had an excellent September quarter. They put cash back in the bank. If you have a look at what's happened with their revolving credit facility, they've drawn that, repaid it. So they've done incredibly well, not just putting cash on the balance sheet, but reducing that debt outstanding at a point in time. So I think, the market is susceptible to looking at stocks like that and taking a snapshot, and that snapshot can be quite emotionally affected. So I think there was a bit of an unfortunate timing with the Oramin deal, which took that buying off the screen. But I dare say that he had a really, really good reason for wanting to do that deal then. And I'm glad he did, because, any of those companies which are seen to be in a slightly strategic position where you can leg someone over and put a gun to their head and try and make a deal for a higher price, sometimes you just need to go, I do want it, I do have to act now. And I think if he'd waited, it would have got more expensive.
So super keen to see where the Sandstone region goes from here, especially $6,000 gold price. I think there's a heap of potential. If we fly through some of the other names in the portfolio, Medallion is another one I'm keen to chat about. They've had a lot more love the last year or so from a really sort of tough couple of years that the company had, and done the deal with the plant. How do you sort of see things playing out through to production, perhaps in the next kind of couple of years? Yeah,
well, massive kudos to Paul there, because he was presiding over an asset which had value. It was high grade. There was a lot of it, a lot of metal, down at Ravensthorpe, and there was a point in time where I think their market cap got down to about $15 million. So that's the market saying, mate,
that's when we sold our shares stupidly.
Yeah. Well, I mean, that's the market saying this is going to be tough. Yeah. And I don't think, no one at that stage was talking about buying nickel processing facilities and repurposing them. There's been a couple of those kind of events that have taken place since. So, spotted a great opportunity and did a deal which took the market completely by surprise. It's not uncommon for someone to do something which there seems to have been a bit of anticipation for. And, Paul is just an absolutely brick wall sometimes in terms of he is so, look, here's the business. We don't really need to wave our arms because the business is good. So I'm not going to give you anything to speculate on. So I think, that transformation was exceptionally well engineered and strongly rewarded because from the perspective of a normal development, it might take two years to clear, get underground, build a plant, build the kind of plant they needed, and changing the plan by saying we'll just go underground, reduce the footprint of disturbance. So all of a sudden, all of your permits have been squashed down into a very short timeline, and you don't need to do anything really to permit the process facility because that's all sitting there. You just reinvigorate. I'm simplifying. You have a delicate, renovation to make it suitable to crush, grind, and process gold. But that's not nearly as big a piece of work as building a new plant. So I think that reward has been very well deserved. But still not a gold producer, so there's probably a bit more to come there. But the fascinating thing about Medallion, from my perspective, is that they'll be invigorating gold production from the Forrestania belt. They've picked up all the licenses which Western Areas and then IGO had over that area. And so if there's gold there, and I mean, it'd be pretty funny if there was no gold there, wouldn't there? Because it's in every other greenstone. They've hired the general manager of geology out of IGO who used to look after that area. So if anyone's going to know where the proverbial bodies were buried, it's the guy who spent the last 20 years drilling it. So great start. But from Forrestania up to Southern Cross and that belt that goes north of Southern Cross, I mean, there's Ramilius at Edna May, but that's a closed project at the moment. There's not a single mid-tier that's sort of in there or looking or active or anything like that. It's all juniors.
Where's Farmers selling? The Mount Holland kind of...
The Mount Holland gold rights.
Some of those juniors getting some love, though, lately.
They have been, but I think this is interesting because, what the Murchison was in terms of the, who will consolidate, who will do what, the Kalgoorlie region, the Leonora region, all of these areas that have been talked about. Forrestania, Southern Cross has been completely overlooked. So them sitting there, you kind of go, well, anything could happen and you don't know. But and if it was just juniors coming together at some point in time, fascinating. So to be the first one and be the one that's in production means that you're probably in a decision-making seat. I feel a bit jealous for the choices which he may have because he could sit on what he's got. He could continue to explore and bring things out of the ground which they already have completely under their control, subject to geology, or they can consider other deals. And I think you put yourself in the strongest position by being at the front. And I got a very warm feeling about that company just because of the momentum that they've got. If they're well supported, then that tends to make me think they'll follow through quite strongly as well.
Don't have to be too jealous. You can just buy more shares on market.
Well, I made the point at our AGM that there's nothing in our portfolio that we are looking to sell. Everything I would say we're looking to top up in, some more than others, but we've got 47 million bucks of cash. We've only invested 43, so that 47's got to go somewhere. I think it'll be into a few new names, but more of it is going to go into the portfolio.
So how about Saturn then?
Well, Saturn's tracking exceptionally well. I think they timed a capital raising probably better than Grady Wolf timed her question about what price is gold going to be in 12 months to me.
They were an underperformer when we spoke sort of 6 months ago, and not long after that they really ran.
Yep.
And now they're a great performer.
Catalysed by the gold price, no doubt, because I think on the face of it, a lot of people would look at Saturn and go, well, it's low grade, so it's extraordinarily leveraged to the gold price. I don't think that many investors across the market, and I was just at the AGM this morning, listening to some of the people in the room, I'd say they understand that there's something there which is probably a bit special. But if you interviewed everybody and said, what do you think the all-in sustaining cost could be for this asset? I think, they'd probably look at you and go, well, I don't know. I've got no idea. Is it going to be high? Is it going to be low? Same answer. Most people assess an open pit gold mine with the assumption that it's going to be an ore zone, which is a fraction of the material that will come out of the pit. And in this case, on their PEA economics, which are old, it was a strip ratio of 1.5 to 1. So there's actually going to be almost as much ore come out of the pit as waste, which is very unusual on its own. And because it's such a fat ore body, instead of having to blast and then mine 2.5 metres, 2.5 metres, 2.5 metres, 2.5 metres, blast again, you blast, mine 10 meters. And you don't have to worry about selectivity because it's all going on the ROM, and then you get halfway over the pit and that's all going to the waste dump. So that introduces a massive cost differential just in terms of moving material. And because of the lack of waste you need to move, then, low cost per tonne of ore, and then the heap leach processing, which suits that mineralisation really well.
Do they even
is the icing on the cake.
Do they even need a heap leach? And I mean, I know the knock's always been the grade, but like, you know what I mean? Like 0.5 grams or whatever through ALL these days is like very economic too.
Well, I think to build I actually haven't discussed that with them, so I'm not falling back on anything they've told me. I think to build a CIL which was big enough for a 0.5 gram head grade would be a massive, massive undertaking. And I can recall when Gold Road was building their project, I had friends working for some of the global majors then, and just prodding them to see what they say because it was a speculated takeover target. And there was more than one of them that said building a gold project that size is something we, as in Gold Major, would balk at because it's so large. It's different to building anything that's been built in Western Australia except for maybe Boddington and, Telfer, because it's just so large. You're not commissioning something at 1 million tonnes per annum. You're commissioning something at probably 10 to 20. So could Saturn go down that track? I'm sure they could consider it. But I think what they found is that, and it's that body of mineralisation is also quite unusual in that there's a lot of it and the gold is exceptionally free. So it comes out very, very easily, which suits heap leach processing where you would expect a bit more volatility. The reason you go to a plant is to underwrite your recovery. And in this case, I think you can have a high confidence argument to say that you will be able to bank the recoveries which they think they'll get. And they have measured as being high. And then some of their test work results have been phenomenal for heap leach testing. So I think when you back that into the conservatism that you apply into a PFS, they're actually coming out with quite conservative numbers there. So would they build a big one? Not sure. The heap leach seems to stack up in terms of the logic. And I don't know. If you went to the regulators and said, could we build a plant 50 kilometres from Leonora and 60 kilometres from Laverton, and it's going to be the biggest one in the area, and we're going to need a lot of water, I don't know how that conversation would go.
Sure. There's one. You've got to leave in 3 minutes, so I've only got time to ask you about one other portfolio company. So I'm going to ask you about the other underperformer because last time the underperformers became the outperformers. Great Boulder. Not that they haven't performed, but it's just like relative to other gold stocks that have, they've got a good endowment of gold there. Like Sidewell looks impressive. This thing should feed a mill. There's many mills in the area. Why is the stock kind of not performed as well as it should have?
Yeah, well, can't speak for incoming buyers. I think we've probably seen, and we haven't sold a single share. We think the project has a lot going for it and got a lot of time for Andrew. I think there's been probably a turnover of shareholders that has just made it a bit hard. You've got some incoming, but there's always some that are outgoing as well, which has probably hung over it. They were, you could probably even argue they were a reasonably well-priced explorer going way back. So as money's been coming into the market, and if money's been doing any comparative analysis, it might go, well, a little bit to Great Boulder, more over there. And there's this question of, at what stage are you really at? They found Mulga Bill. They found Eagle's Nest, which is to the north, Mulga Bill North. It all looks like one continuous piece of mineralisation. And Ironbark. Ironbark looks like something the world can understand. It's exactly the same as many other things which get mined. And Mulga Bill's a bit different host rock, slightly different mineralogy. So I suspect that probably leads to a few people going, well, without you clearly guiding me as to what you're going to do with this, I'm just a bit puzzled. So, and I'd say that's probably played into a little bit of the mentality about the stock. The fundamentals that we think about, it's on the eastern side of the fold, which has the Meekatharra workings down the western side. So geological conditions are very, very similar. Whether there's been a big structure which has preferentially fed the western side or not, it's hard to say. There's been very little exploration on that eastern side, despite it being quite productive host rock. So I think you could probably argue that they're uncovering mineralisation in quite an early stage setting, and that probably plays on people's minds as well. If you're so perspective, why has it sat there? Why have you had prospectors crawl all over it? Why have you had people look at it in the past and turn their noses up at it? I can't answer that question. They're finding gold there. So, it probably shows that they're overturning a bit of a mentality about it as well.
Hedley, we thank you dearly for popping in on the 1.5 hours that you actually had free in your calendar and this single day that you're in Perth late November. Thank you so much for joining us and talking about the industry, the sector we love, and some stocks in the portfolio too.
I appreciate you making time as well. So I don't know how long it would have been before I was in Perth again. So it's been fantastic that we've been able to have a chat, and it's always magnificent to come in and chat to you guys. I don't know if I feel nervous, but I always wonder what the questions are going to be. And you've had my mind racing with a couple of those. So I think on the plane this afternoon, I'm just going to tap out some notes about some essays that I might write, and I'd find a place to post them. So thank you so much for the stimulation, and thanks for everything you guys are doing as well. I mean, the industry doesn't have a mouthpiece, really. There's so many companies doing so many things, all trying to put their best foot forward, and you guys are bringing a lot to the front, for companies, for the industry as a whole, for commodity sectors, educating investors, and that, major kudos for you guys for what you've achieved there. So thank you for having
Appreciate
me.
that.
Cheers, Hedley. Thank you.
Hooroo.
Hooroo.
There we go, mate. Always fantastic to speak with Hedley again. And a big thank you to Sandvik Ground Support, Exceed Capital, check them out in the show notes, as well as Switch Technologies, Intralinks, and Focus, the platform by Market Tech.
Hooroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read out a